Welcome back. The next company in our China series is Baidu. Baidu is an internet search company that also has a video sharing platform and has recently been venturing out into the AI world. Does that remind you of anybody here? So anyway, if you Google them recently, or I guess if you Baidu them, did I do that right? I don't know. You'll see that they won some kind of contract for robo-taxis. Look, I got it down here. You can see Baidu gets green light for commercial robo-taxis. It's good for the stock. All right, that's good news. Well, we're going to look at the share price history and just check out what's been going on with the stock, and then we're going to go into the fundamentals, the financial statements, and see if those are good for the stock, which is usually more important than news articles. Usually. All right. Let's start with a one-year chart. Okay, so you can see, about this time last year, they had a run up to about 140% of what it was previously. And then just like all the other China stocks, they got hammered and are down over 50% from their peak. So like I said, we're going to go through the fundamentals, go through the financial statements, see if that was justified, and see if it could be due to come back up. So let's get started with the income statement first. All right, total revenue, that's what we always start with. This is every quarterly report going back about 10 years. We're going to operate in the Chinese currency and then convert at the end because it just makes my life easier. All right, so this growth is incredible. Look at this. In 10 years went from 2 billion a quarter to over 30 billion. That's the kind of growth that you love to see. We don't use revenue for valuation metric, but it is always great to see revenue growing like this. So let's go to operating margin. Sometimes you use gross margin, but for tech or service companies, I'm going to use operating margin or net margin. Let me change this to percent. All right, this is not as good. So look at their margins whenever they first started, over 50%, and it's just been declining. So this is not always a bad thing. Obviously, if I had the choice between margins growing and margins shrinking, I'd take margins growing 10 times out of 10. But what this could be, and you see this a lot with tech companies, is that they're just reinvesting so much back into the business because they want growth. That's all they want. So their margins are lower because they're just constantly pouring the money back into the business instead of turning a profit. The issue I have with that is that just from looking at the financial statements, it's hard to tell if that's what's going on or if they're losing some kind of competitive advantage and having to lower prices to retain market share. If you were going to do a deeper dive, that's something you'd have to verify before you bought the stock, in my opinion. All right, let's move to pre-tax income, our first valuation metric. Gotta change this back. Okay. This is all over the place, and we have some huge outliers. So you can see we're hovering well below 5 billion a quarter, and then you have outliers in the plus or minus 20 billion yuan a quarter. Something's up there. And it doesn't mean something's wrong and that it's a red flag, but what it means is that you need to go see what's causing that. And then usually if it's an other income or a non-recurring expense, you're going to want to subtract that out. So that's what I did. Real quick, we're look at other income. So where is it? Other income expense, other income or other expense not related to operations. So yeah, this is where those spikes are coming from. And it looks like they kind of offset each other. We had a plus 20 and a minus 20 billion. So what I'm going to do is take our pre-tax income and subtract all of this out. Subtract all our non-recurring because I want to get an idea of what the business is going to do in the future from a consistent standpoint. I'm not interested in non-recurring expenses. So I did that, and what I have is adjusted pre-tax income. Okay, so it's good to see growth here. I was a little worried with that low margin that we were going to see a flat line on their income, but it is growing somewhat. So like seeing that. We are going to take the average of about their last 6 quarters to get our valuation. So if I do that, the average of the last 6 is 4.4 billion yuan per quarter. So if I make that a yearly number, 4.4 times 4, 17.6. I'm going to round up and just say 18 billion for the year. So now we need to get a growth rate. What we normally do here is we go back about 5 or 6 years, see what the income was there, and then annualize that growth rate to what we're doing currently. So if you go back about 5 or 6 years, you can see we were around 3. So let's just say 3. And we just saw that we were at 4.4 recently. So I'm going to do 4.4 divided by 3, and I raised that to the 1/5 because it was over a period of 5 years. And that is our annualized growth rate. So 7.96%. I'm going to round up to 8%. So a growth rate of 8%. All right, awesome. Next, let's do earnings per share. And I'll just show you real quick. We're going to have the same issue that we had with the pre-tax. You have these 2 big outliers here caused by the other income. So what I'm going to do is subtract that out and same thing, adjusted earnings per share. So this is what we have. And the formula that we use for this valuation is going to call for the trailing 12 months. So in most cases, that's what I do. If I take the trailing 12 months or the last 4 quarters, I get 44.34 for earnings per share yuan. 44.34. Awesome. All right, so let's go to the balance sheet. All right, first up, tangible book value. We like to look at this, make sure it's growing. So this is everything a company owns minus everything it owes. And then we also subtract out all the intangible assets. And so this is kind of a liquidation value of the company. You know, if it sold all of its assets and paid off all of its debts, this is what it'd be worth. So we love to see this growing. It's a great pattern. I know it's shrinking here recently, but in the grand scheme of things, that's nothing to concern me. Like to see that. Real quick, I'm going to go to total assets and get a return on assets. So return on assets is a great way to judge a business on a pre-tax basis. It's very intuitive. Basically, we're going to take the adjusted pre-tax income that we've found and divide by the total assets. So if I do that, our adjusted pre-tax was 18 billion. So 18 divided by, and if you look here, the most recent one is about 380 billion. So 18 divided by 380 is 4.7%. I'm just going to say 5%. That's a little on the low side. We like to see higher return on assets than that, but we know that's related a lot to that shrinking margin that we talked about in the income statement. So I'm not too concerned with that. So next we're going to look at tangible equity per share. That was that same number that we just looked at first on the balance sheet, but then I'm going to divide by the number of outstanding shares. So tangible book per share. Book value is also your equity. So what I'm going to do here is use this to get a return on equity and a price per book multiple. So what we do is, since this is after taxes and on a per share basis, we're going to take our earnings per share. So 44.34. and divide by the most recent number, which if I scroll down here is 486. So divided by 486, and I get 9% return on equity. That's okay, it's low, but hopefully they're selling at a low multiple of book value too. So now I need to get the tangible price per book multiple. I take that, what was it, 487? Yep, 486. And I got to get that to dollars, so times 0.16, and that's $77.76 per share. So I take the actual price, so 153 divided by that, so 153 divided by 77.76, and we get a PB, a tangible PB of 1.97, so 2. I'm just going to round up. So that's a pretty low price to book, especially for a tech stock. But I think there's a reason it's low, and that's that they're getting pretty low return on their assets and equity. But like we said, that could be all tied to that lower margin reinvesting into the business. All right, let's go to the cash flow statement. The cash flow statement, I can only go back about 4 years to 2017 because that's all I could get. And we're only going to look at free cash flows. So just keep it simple. I'm going to just take the average of all these last 15 quarters that I have. I'm going to take that average, and that's going to be what I put for my valuation. So my average is 5.6 billion. So 5.6 billion yuan times 4 is 22 for the year. So 22.4 billion. All right, we're not going to look at anything else in the cash flow statement. I didn't see that they were paying dividends or buying back shares, so I'm just going to ignore that. Let's go to valuation. Let's get a number. All right, first one, our pre-tax income times 10 divided by the number of shares. So our pre-tax income was 18 billion yuan, so 18. I'm going to convert that to dollars first. So to convert to dollars, times 0.16, then times 10 divided by the number of shares, divided by 348 million, so 0.348 billion. And I get $83 as my price target for the pre-tax income. We knew this one was going to be low because of those margins. We knew that was going to happen. Next one is our earnings per share and growth formula. So let's see, 44.34 times 8.5 plus 2 times 8. All right. So we get 1,086 yuan per share. So I have to make that dollars. So times 0.16, and I get $174 per share. Awesome, that's solid. Okay, and lastly, we're gonna do the discounted cash flow, the DCF method. So free cash flow numbers gotta be inputted in here in dollars. So I gotta go 22.4 times 0.16. That's gonna give me my dollars. So $3.6 billion a year is our free cash flow. Perpetual growth rate, I'm gonna go 6%. It's lower than their 8, but it's still pretty generous. And then a 15% on our discount rate, and I get a net present value from the market cap of $46 billion. So if I do 46 billion divided by the number of shares, 0.348, I get $132 a share. All right, so we got 3 numbers. The growth one usually comes in higher with these tech companies, and the pre-tax one's always a little harsh on them, but I do think they average out to be a decent price, and you can see the average of those two is pretty in line with what we got for the DCF. So our price target is lower than the stock. Does that mean it should be avoided? I think definitely not. It's very hard to value companies that continue to increase revenue but haven't yet turned the knob to really start ramping up the profits. For me, that's enough to stay away, but that doesn't mean it's a bad company at all. I'm just lazy. I want to find easy decisions. But But I can totally see how if they continue to grow revenue and they do wind up turning a big profit, they blow these valuations out the water, and rightfully so. I mean, come on, robo-taxis. Alright, well, if you learned something, if you enjoyed the video, please like and subscribe. Let me know what company you want to see next in the China series, and I will see you next time.